Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, June 5th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. I do want to remind everyone that we've got our trading room coming up live at 10 a.m. this morning, so that's an hour from now. You do need to be a member, so make sure you sign up for a 30-day trial this morning, if you're not already a member, and come join us. We'd love to have you. Going to be a lot to talk about for sure. We're going to see how the market reacts to the ADP employment report, which was released this morning. It came in actually pretty good in terms of what you might want to see. It's almost like, it's definitely not hotter than expected. We didn't want that. And we want a little bit less than expected, but we don't want a lot less than expected. So we kind of want to pigeonhole with a mild disappointment so that the economy still appears to be strong, but yet weakening to help take some of the inflationary pressures off and maybe at least have the Fed beginning to think to lower rates. They will be meeting next week, next Tuesday and Wednesday. There is a ton going on between now and then. We've got the non-farm payrolls coming up on Friday morning at 8:30. Next week, the two-day Fed meeting, Tuesday and Wednesday. We've got May CPI coming out Wednesday morning, and then the May PPI coming out Thursday morning. So there's going to be a lot for the Fed a lot more evidence, I guess, for the Fed to be analyzing and trying to decide where they want to go. Personally, I've seen some things that are starting to make me a little bit more nervous about the market in the near term, not the long term, but the near term. I do think that the economy is weakening. I don't think we're heading for a recession. However, I do think if the Fed waits too long to cut rates, then I think the problem could maybe linger a little longer in terms of the economy, maybe, possibly even hear more talk about a recession, which obviously would not be good for the market. And we've got the presidential election coming up later this year. So I'm already expecting that we're going to have some uncertainties over the summer, which could impact the market. And so it's going to be interesting to see how the Fed handles all this, and not just whether or not they cut, because I think most market folks do not expect to cut next week. I think, they've been all over the place. I think the Fed's been all over the place. I think they should cut next week, even if it's a small cut, but I don't think they will. I don't believe they're going to cut probably until September, which I think is too long to wait. I think they're risking a recession by doing so. And you might think, well, okay, but, got to make sure inflation's under control. I've seen nothing but the inflation rate drop now for close to 2 years. So I don't know, if dropping from 6.7% on the core CPI annual rate down to 3.4% or wherever we are right now, 3.4, 3.6. I mean, that's most of the way down to 2. And I realize this last 1.5% probably going to be the toughest because now we've got some lower prior readings from last year on the CPI that we've got to continue to go below. But everything I look at, whether it's the monthly, whether it's the annual, continues to show decreases, continues to show a decline. So I think they'd be better off not waiting too long to cut. But the ADP report that came in this morning, last month, April, had come in at 192,000. They lowered that to 188,000. And then this month, I believe, was expected to be 170 or 150 through. Hold on, let me make sure I get these numbers right. Yeah, 173 was the consensus, and it's come in at 152. So still plenty positive, but also 20,000 lower than expected. So I think that probably is about where the stock market would like to see these numbers come in. I don't think we want to see a big jolt, like all of a sudden a negative number. I don't think that would go over very well, especially on Friday. If we come in with a negative jobs report, and then next week the Fed doesn't do anything, I don't like that combination. So We'll see what happens. I don't want to see any major surprise on Friday, but a little bit below expectations, kind of like what we've seen this morning with the ADP, I think would go over pretty well. One other thing before we get going, CrowdStrike did report solid results last night. We are seeing a big jump in the stock. I'll give you then a few numbers here before we look into the charts. But the first thing is CrowdStrike right now is up $34. Yesterday I indicated I thought, if I had to make a guess, if I had to do something one way or the other, I would have gone long CrowdStrike. It was one of the leaders in software. It's been a leader. And I said, the group itself is not, hasn't had the greatest results. But even when we've seen good results, we've seen not so good market reactions. I thought this one was important because CrowdStrike's been a very important leader. It's one of our portfolio stocks. I thought it was going to have a good report and potentially a good reaction. I said, watch 360 to the upside, and I think 280 to the downside, something along those lines, maybe 275. Anyhow, we are getting the gap up. We're not at 360, but we had closed yesterday at 305, and now we're at 339. So up $34, which is more than 11%. So a nice reaction there. As far as futures go, before after the ADP report, we've got the diamonds right now up about 1/3 of 1%. The spider is up about 0.4 of 1%. QQQ, which of course tracks that high growth NASDAQ 100 index, up about 0.7 of 1%. And small cap IWM up almost 0.6 of 1%. So we are getting a positive reaction. We'll see whether or not we can carry it on, because we have not performed very well with the 10-year Treasury yield dropping, which is a little bit of a concern to me, especially small caps. We've seen almost a 100% inverse relationship between small caps and the 10-year Treasury yield throughout 2024. I mean, I for the most part, I've been able to tell what the IWM is doing simply by looking at the 10-year Treasury yield. That has not been the case the last 2 days. We have seen the yield drop significantly, while the IWM, or the Russell 2000 small cap index, has also been falling, and not just a little bit. It's fallen back down to key support, closer to that 200, 202 support range on the IWM, gap support. So when I start to see that, I start to look for what the market's trying to tell us. The only thing that I can come up with that makes sense is that the rate now is dropping not just because bond traders believe inflation maybe is getting in check, but it also could be dropping as a result of the bond market beginning to fear a possible recession, or at least a weaker economy than they expected. And it could be because the Fed's waiting too long to do what they need to do, which is to start cutting rates. So if it's because of the latter, if yields are dropping because of the economy, that definitely makes sense why the IWM would drop and why overall stocks might struggle a little bit. So if we keep seeing that yield moving down, the Fed doesn't come off its stance, I think we got to be really careful. I think, right now the VIX is still down in bullish territory, which I think is fine. We're still holding on to key support, and that's really the key right now. Is we've got the IWM holding gap support. We've got the S&P 500, NASDAQ all trending higher. And so we haven't had a breakdown. Now, if we start seeing all these negative signs, at least what appears to be negative signs about the economy, and then we start seeing breakdowns, that's going to be time to really hunker down and become much, much more conservative. I think it's a little early right now, but I kind of got the hair on the back of my neck raised a little bit, just based on what that 10-year Treasury yield's doing and what we're seeing in other markets. The intermarket relationships aren't making sense if we're dropping just because of inflation. So anyway, that's just something to think about as we go forward. All right, let's take a look at what happened yesterday in the market. Had a little bit to talk about there. Sorry, it took a little bit longer than normal to get to the charts, but just wanted to chat a little bit. Anyhow, Dow Jones Industrial Average yesterday up a little more than 1/3 of 1%, up 140 points, getting back up close to the moving averages, not quite there yet. S&P 500 gaining 8. That was a little bit, between 1 and 0.2 of 1%, but still above the 20-day moving average, still consolidating after a new breakout to an all-time high. And this is what I was referring to earlier about the market still looks pretty strong. Here you can see the S&P 500 continuing to set new highs, all-time highs, and trending above the 20-day moving average. Hard to get really bearish the stock market when we're doing that. And at the last high, you can see that the PPO also set a new high at this high. So I think momentum is strong. We've come down. We've held that rising 20-day moving average. Technically, I wouldn't be surprised to see the S&P 500 move back to an all-time high if this is the only thing that I'm looking at. Of course, we look at other things, which is why we've got to be careful if we do start to break down these in major indices. NASDAQ 100 also rising yesterday about 0.3%, 54 points, tested that 20-day moving average for the fourth straight day and held it for the fourth straight day. Mid caps 400, S&P 400 mid cap, taking on the chin yesterday, down 1.3%, 39 points, challenging the low that we saw toward the end of May, also into this gap support zone that begins somewhere around the 2,900 level. I'd like to see it hold 2,900. IWM, this is what I was talking about, that 200 to 202 area where we've had the gap support. You can see the test that we've had right around 202. Yesterday, down 1.3% on the IWM, dropping $2.73 back just beneath 202. So this area has been very good support over the last 30 days or so, and we do have that gap support from about 200. If we fail to hold, it's not like it's the end of the world, but it's going to start looking more and more like the low 190s could come into play, like they did back in April at the April low. And then also back during February, we actually went down a little lower into 190. So I just don't want to go below 200 because at that point, we're not really seeing a whole lot of support until we get to that April low. And that would be another $10 from where we are right now on the IWM. Would not be feeling very good. Transports rolling over again to the downside, finishing near the low of the day, down 137 points, down almost 1%. So all of that strength we saw at the end of last week, pretty much gone the first 2 days of this week as we roll over and again stare down that key support level down around 14,750. Moving on to sectors, real estate, you're going to see some defensive groups up here. So again, you talk about, we got a nice little rally in the market yesterday outside of small and mid caps, and yet leadership came from real estate, up almost 1%, and staples up about up about 2/3 of 1 point, or a little bit more than 0.8%. So staples continue to outperform the discretionary area, which is one thing that I really watch very closely. I think that relationship is possibly the most important intermarket relationship we can watch. I do think that there was a massive move to the upside in discretionary versus staples a while back. And whenever you see that, it's just like a stock. If you get a stock that goes from 100 to 200 and it pulls back to 100, you're not going to be very happy. But if it goes from 100 to 500 and pulls back to 250, then it's not nearly as big a deal. I mean, stocks that run up really fast tend to pull back. Same thing with the stock market and these intermarket relationships. When you get a big push to the upside, and many of these defensive groups lag for a long time, which is what many of them did. I mean, real estate's been horrible for a while until about February or March of this year. Utilities were horrendous, really bad relative performers. Staples, way behind discretionary, lagging. All those things have changed a little bit, but the market hasn't broken down. And we don't have the sentiment issues like we had back at the end of 2021 when defensive stocks were leading all-time highs. So it's not the same situation, but it still merits consideration, merits monitoring. We want to continue to watch it and see if any other signals would start to support the theory that the market is trying to top. Right now, I'm not seeing that. And one reason, communication services up yesterday, another 1/3 of 1%, closing near 84, breaking out to a 2024 high and not far from an all-time high, trying to clear the high from a couple of years ago, which also was right around the 84 level. So XLC looks really strong here still to me. This is one of our aggressive groups. Now, I'll tell you something that's maybe wasn't quite so bullish about this group in just a second. First, recreational services. This is a group that broke out. Look at this move to the upside, taking out all these prior highs. So that was a nice breakout on recreational services. That, of course, includes many of those cruise lines and so forth. Those stocks have been doing extremely well of late. And we are, like I said, seeing a breakout to a new high. So you got wireless stocks and fixed line communications. These two groups were the two leaders in communication services. So you got mobile communications moving up close to 2%, 1.9%, forming what looks to me like maybe the completion of a cup. This is talked about the IWM and the fact that the cup was kind of leaning a little bit, and I like to see it go all the way back up. Well, this is more of a rounded cup, and we do go all the way back up, and it looks like a cup you could actually drink out of without spilling. So I think this group looking stronger, but these two groups, if I had to name two of the more defensive stocks or areas within communication services, this would be it. Fixed line telecommunications. Here we got a breakout again above these prior highs, but this is more defensive oriented. So one of the things is, and the question I'm asking myself, is this simply money rotating from offense to defense for a period of time, which does happen during secular bull markets before we go back, money rotates back maybe in another month or two? Or is this money rotating into defensive groups with the anticipation of a market breakdown ahead? Well, first thing you have to do, it's kind of like having a head and shoulders top. And I see a lot of bears, even in a bull market, always wanting to call head and shoulder tops, but they never execute. It looks kind of like a head and shoulder. Usually it's kind of an upsloping head and shoulder, which I don't favor. I usually favor the downsloping head and shoulders. The neckline was actually flat or even going a little bit lower, because that's telling me that we're starting to break down below those prior lows. We're actually moving below prior lows. So not only is it a head and shoulder pattern, but we're seeing some short-term breakdowns before we get that right shoulder and then back down. A lot of folks try to call these rising trend lines head and shoulders because we have a pop, we come back down, we have a bigger pop, and then we come back down, but it's still rising lows. I don't like those kinds of head and shoulder tops. Anyhow, we do want to see confirmation on charts like the cup with handle. And if the market is going to, if this is a signal for a possible market breakdown ahead, we need to see the breakdown. We need to see the major indices start to roll over. We're in a secular bull market. I am not going to be looking for tops and trying to make excuses for the stock market here. This is a top. Nope, this is a top. Nope, this is a top. How do you trade with that mentality and mindset when you're always looking for tops in a secular bull market? When we're in a secular bull market, I'm bullish until signals beat me over the head, and then we get the follow through to the downside. If you remember back in 2021, when I called the market top, I said we've got a very likely, or certainly a potential for, a cyclical bear market in 2022. I went through all the reasons, but I said this doesn't confirm until we get a price breakdown. So I even talked about it was around 4,700, I think, at the beginning of January of 2022. And I said I thought, we would go down to 4,300, which would essentially establish a neckline. From there, I wasn't quite sure. I thought we'd go to 4,300, but I needed to see that further confirmation to believe that we were going to go all the way back down to 3,500, which is what I talked about in early January 2022. And we were, like I said, 4,700 at that point. So I could see a lot of clouds on the horizon, but we needed that breakdown. Here, I see some clouds on the horizon. It's nothing like it was at the end of 2021. If anybody tells you that, ignore them. I won't go back into it, spend too much time. But there are some signals that are signaling cautious, be a little careful. And I've been talking about some of those. I've been talking about transports for a while. I mean, that's one of the bigger ones. The transport's not performing well. But we're also now seeing some other things like copper. Copper looked great 2 weeks ago, and all of a sudden it's just, it's fallen like a rock. It's kind of like what's happening with the 10-year Treasury yield dropping, and all of a sudden small caps going with it. It's like, whoa, that's kind of not anywhere close to what I was expecting. Same thing with copper. We got a breakout, and it's like, oh, this is a good sign for the global economy. And then all of a sudden copper in 2 weeks completely falls apart. So I don't know if the market is starting to send us that message that, hey, we're teetering here now with the economy. And if that's the case, watch these, trend lines, watch these moving averages, watch gap support, like I was talking about with the IWM. We need to see these levels hold and continue to move higher and break out the new all-time highs. And some of these secondary signals start to repair themselves. But I'm not turning bearish. I'm still very bullish. And even if we run into a recession and things do morph into maybe a correction, or even worse yet, another cyclical bear market, I don't see that coming. But even if that were to happen, my long-term signals are bullish. So it's going to be no different at this point, unless some major changes occur. It's going to be no different than when we went into the pandemic, middle of the pandemic in 2020. I said, we're in a secular bull market. We're going to rally out of this. It's a healthcare crisis, not a financial crisis. Then we get into 2022. And even before I called the cyclical bear market, I said, it's only going to be a cyclical bear market. It's not a secular bear market. Started going down. Everybody was talking secular bear market. We came right back up, set all-time highs. That's the if, and this is a huge if this morphs into something more serious, I think it would be cyclical rather than secular. But anyway, getting way ahead of myself. I do not expect, let me be clear, I do not expect a cyclical bear market. But I do think that there are messages being sent to the Fed to lower rates and to lower them sooner rather than later. We'll see what they do next week. I do not expect they're going to lower them, though. All right, moving on. Speaking of the yield, 10-year Treasury yield, let's get an update, see where we are. We're down again, or at least we were. Yeah, still down. We're down another 1.5 basis points, something like that, to 4.32%, challenging the low we saw in mid-May, and also challenging basically the breakout that we saw from about the 4.35 level off of that double top back in March. If we go much lower from here on the yield, I would consider that certainly a breakdown of this intermediate term uptrend, or maybe you call it a short-term uptrend, depending on your time frame. But to me, that would be a clear break, because all of a sudden now we couldn't get back through the prior high. We're starting to roll over, setting new lows. That would be a telltale sign to me that the yield is rolling over. And this is coming right ahead of the Fed. I mean, if the bond market's not screaming right now to the Fed that inflation's not a problem, I don't know what is. Unless we have a big reversal over the next week heading into that Fed meeting, I think the bond market's telling the Fed, okay, this is it on inflation. Stop the inflation talk. Let's talk about the weakening economy, and let's talk about lowering rates. But we'll see if the Fed gets the message. S&P 500, and I doubt it, by the way, just because this Fed's already been behind the 8 ball multiple times. They're all over the place. They're not exactly transparent in my view. So I don't know what to expect out of that meeting next Wednesday, if I'm being honest. S&P 500, we did set the new high. We have been holding on to the rising 20-day moving average. I think here, first of all, you got a higher high, so you don't want to take out this low. So the low that was set back in April, 49.70 or 49.60, whatever that was, that's the low that I think is the critical low on the S&P 500. So we've still got, from this point, probably 6% or so down to that support level. And I don't think we're going down there. I would continue to watch this 20-day. And then if we break below that, watch the 20-week. So if you look at a weekly chart on the S&P 500, you can see the weekly comes in right now at 51.03. And the daily 20-day comes in at 52.53. So if we lose 52.53, watch the recent low that we had near 5,200. If you lose that, that means you're also losing the weekly, that 20-week moving average, which to me is a much more significant loss than the 20-day. NASDAQ 100, pretty much same thing. New highs. We've pulled back. We've hit that 20-day, nice reversing candle. We're working our way back up, trying to make a breakout. We've got futures up again this morning. We'll see if we can get back through to new highs. The weekly chart on the NDX shows the 20-week at 17,877. That is roughly 870 points below where we are right now, which would be maybe about 4%, 4.5% to the downside. So that's kind of what I'm talking about in terms of downside that I would be okay with. We go below that 20-week moving average, along with some of the other signals that we've seen. I think short term that is going to present some problems for the market. But without the price breakdown, I personally would still remain bullish. And I am still remaining bullish. IWM, this is the one that really, just the action the last 2 days with that big move down. And again, if you go back to that 10-year Treasury yield, and actually, let me pull up correlation here on this chart. Actually, we don't need that AD line right now. Let's pull up correlation with the S&P. Or excuse me, no, let's change it to the TNX. And let's see. So do you see this inverse correlation? Whenever we're negative, it's inverse correlation. It means if the yield goes up, the IWM goes down. If the yield goes down, the IWM goes up. So they've been moving inversely to one another really since back in August of last year. We had one little blip here, late January into February. But other than that, I mean, we have been in inverse territory and mostly down near -1, which means they are completely moving opposite of one another. And then you look at the last 2 days going down while the 10-year yield's been going down. And that's what leads to this rise that we're seeing right here as we start to move more and more toward positive territory, which, as you can see, again, since August of last year, we haven't moved back above -0.5 except on 2 occasions. Here we got to -0.5 and then we dropped right back down to -1. Here we went through, that was the January, February period where a lot of money was rotating into value as opposed to growth. And then we went right back down. And so maybe this is similar. It's moving into value. This didn't turn out to be any major problem. The market went back to all-time highs after that. So that's why right now, this moving back up and money rotating into value isn't concerning me unless we start to see those price breakdowns. So this one, I've kind of got a red flag that I'm kind of seeing peripherally, but it's not right in front of me. It's not beating me over the head. It's just like, okay, we got this issue over here. We need to continue to watch and deal with. But as long as it doesn't morph to the point where we see price breakdowns, that's really what I'm thinking about, what I'm trying to drive home here. Transport's ugly. I mean, I don't know what else to say. The daily chart really since the beginning of the year is just haven't participated. Stock market's been going up, setting new highs. We've seen growth stocks lead. We've seen value stocks lead. We've seen just about everything lead except transports. Transports just, for whatever reason, not doing well. And this tells me one thing. The economy is teetering. The fact that we're kind of consolidating in a weekly, long-term weekly chart here tells me we haven't really, I'm not thinking we broke down. I mean, look at what happened back in 2022 when we had the cyclical bear market. I mean, we went down and we were setting basically 2-year lows. Here, we're not doing that. We're trending up. I mean, if you connect the lows right here, I mean, we're still trending up. If you connect the highs, we're kind of trending down a little bit. So it's almost like squeezing in a triangle. So the weekly chart just looks like a lot of consolidation, a lot of sideways action. The economy okay, but not flying. That's kind of what I get from this chart. But if we don't look at this chart, if we don't have perspective and back up and look at the big picture, only looking at the short term, then we see this. And this has obviously been a thorn in the side of the market. All right, moving on. Chart of the day. Just want to mention for everyone who is maybe new to Earnings Beats, go over to earningsbeats.com. This is where I live. And start a no-cost trial. You can click on that button and you can come into our trading room, which is set to begin in about 30 minutes, 10 a.m. We'll talk about some possible trades today. I may make a couple. You can follow along. You can watch. You can paper trade. You can trade yourself if you want. Only thing I would say is that if you trade, you're taking the risk of your trade. Obviously, I can't take that risk. All I'm doing is showing what I'm doing, trying to teach you some of the things how I look at the market. I have different strategies for trading very short term. I have different strategies for swing trading, and I have different strategies even for the long term. Right now, I mean, I've been holding some ETFs for a long time, which ordinarily prior to 2020, I never really did much of. I traded almost all individual stocks, but I've actually held on to some pretty large positions in ETFs simply because the rotation's been so crazy. by the time you start seeing strength in one area and you start getting invested in that area, the carpet gets pulled out from under you. So I personally was finding it very difficult to trade individual stocks for a while during the pandemic. And so I just said, okay, I feel good about the market. I'm just getting into the ETFs and eliminating a lot of the stress related to individual stocks and the whipsaw. And so it's worked out for me pretty well over the last few years. And so again, there are different strategies, but I am starting to trade more stocks. And so we'll talk about that more at 10 a.m. Anyhow, if you scroll down here, you'll see an area where you can sign up for the EB Digest. That's our free 3 times a week newsletter. It's really not a newsletter. It's more like a chart of the day. It's 2 paragraphs in a chart. That's normally what we feature. And again, Monday, Wednesday, Friday, no credit card required. You can unsubscribe at any time. All you have to do, name, email address, hit that subscribe button. The other thing, the bonus that comes out of this is once you subscribe and you become part of our EB community, anytime we have a free webinar, we will reach out to all of our free subscribers to make sure that if they can either come or we'll send them, we do send out a recording. So you can just go back and watch the recording at your leisure. But those are many times very educational. Sometimes there's information you can act upon if you wish to. But anyhow, that's kind of a secondary benefit to joining here. In addition to the 3 times a week chart of the day or newsletter, you also get access to all of our free events that we do. So the chart of the day I wanted to mention today, it is 9:30, so I'll make this really quick. The chart of the day here, you can see G3 Apparel Group. And as you look across here at the AD line's been very strong. Even as we've pulled back, the AD line has gone up to set new highs. So that tells me, even we had a gap down back in March. I'm assuming that was earnings related, but we actually gapped down and then came back up, closed near the high of the day. AD line went up. So yeah, it was a gap down, but market makers, it looks like to me, has been buying ever since. We never even went back down to test that level. And so the relative strength, it dropped a little bit here because of that gap, but otherwise relative strength has been going straight up. The only bad thing on this chart is that clothing and accessories have been weak, but we're starting to see better reactions to earnings reports in clothing and accessories, in apparel retail, in footwear, in a lot of the different retailers, specialty retailers, and so forth. So I think this group is being treated a lot nicer right now. And the stock is one of the leading stocks with a strong AD line. I could be wrong, but I wouldn't be surprised to see the stock gap up to around $35, $36, maybe challenging that December high, maybe even breaking above it. But I would be looking for that. And that's tomorrow morning, by the way. They report tomorrow morning, so I wanted to point that out. Copper. I talked about copper earlier. So I wanted to just walk you through the fact that copper, here was that move up to 520. And I want to show you how important this move was. This is going back the last 15 years. We went up and hit 520, which was higher than at any point over the last 20 years or 15 years. And I'm going to drop it back even further. We'll go back 30 years, double it. That was the high over the last 30 years. That's the all-time high. That was just a week and a half ago. If we pull up that daily chart, or maybe it was 2 weeks ago, right about 2 weeks ago. And in the last 2 weeks, we've gone from 520 back to 450. Now, all we've done really is just given back this huge move up, but it definitely begs the question, this was kind of giving us a signal of, okay, this is almost always a good sign for the S&P 500. When you've got copper going up, because copper, unlike gold and silver, copper is an industrial metal. We see a lot more use of copper in construction and so forth. And so as a result, when this price goes up, it's telling us there's economic demand. And if there's economic demand and prices are breaking out on copper to all-time highs, that's a really good signal for the S&P 500. This is an index of multinational companies. So they're going to benefit from that increased economic activity that stems from the rising copper prices, that increased demand. But what do you make of the last 2 weeks? I mean, I'm not quite sure what I make of it just yet. I'd probably, if it was the only thing I was seeing, I'd probably say, well, it's probably just pulling back and likely to go right back up. But we've seen weak jobs report last month. We've seen, defensive groups leading, so things getting a little bit more cautious there. We've seen initial jobless claims rise a little bit above where they were prior. I mean, we're seeing things that just seem like the economy is getting just a little bit weaker, and then all of a sudden we get the big drop in the 10-year Treasury yield, and the intermarket relationships start to reverse. So I'm not quite sure what the heck's going on right now. I know one thing: S&P still in an uptrend, Nasdaq still in an uptrend. I'm sticking with that. But I think we have to be aware of some of these other signs that could lead to something further down the road. You don't want to have blinders on. Some of you probably think I'm perma-bull. I'm not a perma-bull. I am close to a perma-bull because the stock market goes up a lot more than it goes down. If I'm going to be wrong, I'd rather be bullish and wrong than be bearish and wrong. Look at the last 2 years. Everybody's still living in that bear market from 2 years ago. Imagine trying to look at the stock market right now after the last 2 years. We've gone from 3,500 to 5,300 on the S&P 500. That's more than 50%. Imagine being short or having the shorting mentality while you watch the market go up 50% in less than 2 years. That's not a good feeling. Anyhow, stay bullish until price action confirms any kind of, don't take one signal and say, that's it, bull market topped. We got to see multiple signals, and then we need to see price action confirmed to the downside. We're not seeing that. Anyway, that is essentially it for what I wanted to cover today. Let's take a look, see what's going on here in the first 5 minutes of trading. We do have the Dow up a little bit, S&P and NASDAQ up a little bit more. Russell 2000 up around 1/3 of 1%, so that's not too bad. The VIX back down near 13. The VIX is staying low. If we're about to see some weakness ahead, the market makers aren't showing their hand yet. And this essentially is what I look at in terms of market makers showing their hand of what they think's coming. And I would rather listen to the market makers than CNBC any day of the week. And the reason I say this, you have to know how the VIX is calculated. But essentially, market makers determine the premium on the S&P options, on all options. But the S&P options are what goes into the VIX calculation. Short-term S&P 500 options. So when the VIX is low, what it's telling us is that there's a smaller premium, a smaller spread on the S&P 500 options. And the reason that's significant, if market makers expected a big move in either direction, but especially to the downside, they would be pricing options much more expensively. And as a result, we would see the VIX probably climbing to 15, 16, 17, 18. We're not seeing that. We're seeing the VIX staying down around 13, which is really nirvana during a bull market. Anything when you're below 13, that's the absolute best performance on the S&P 500 going back since the beginning of this bull market. I went back and studied what the S&P 500 did when the VIX was at various levels. Below 13 is the absolute best performance on the S&P 500. We want the VIX below 13, and we want to stay there. 13 to 17, very bullish, but that would be the next rung. We want to be down below that 13 level. Anyhow, I think that's probably about it for me. Again, I'll be coming back in about 22 minutes for our live trading room. Look forward to seeing our members there. And again, if you're not a member, 30-day free trial, start it today and come in and join us for the next 5 Wednesdays. That'll give you 5 Wednesdays. Anyhow, I'll see everybody in about 20 minutes. Have a good day. Happy trading.